I'll give a bit of a primer in terms of what I'm trying to do and who ARK is. So ARK is the only public fund manager that holds Bitcoin. We bought it in 2015. A lot of people thought we were crazy and buying into a Ponzi scheme and expected Bitcoin to experience a long, slow death. That narrative has changed. Nonetheless, we remain the only public fund manager to still hold Bitcoin. So Bitcoin's the #1 position in 2 of our ETFs, so above Facebook, Amazon, Netflix, Google, to give you an idea of our conviction. Now, in order to add Bitcoin to our funds, we had to basically investigate it as we would investigate any stock in terms of the models and how it would fit into a portfolio, what is the utility value of this, what is the price floor. And so a lot of what I'm trying to do and hoping to do, and the panel was talking about it before, is to create new valuation techniques. I wrote a paper about a year ago with Adam White of Coinbase, basically calling this a new asset class. And at the time, the aggregate network value was 10 billion. And so we may have been a little early in making that claim, but I think it's definitely coming to fruition. And I ran a poll on Twitter recently, and it seems consensus that we hit $1 trillion aggregate network value in the not too distant future. So it's going to be really important, as we were talking about in the panel before, for us to figure out what's utility and what's speculative. Because in times of corrections, we will likely compress through speculative value until we hit utility value. So a good example with Bitcoin of utility value is we can just do a thought experiment. So if we say Bitcoin is going to take 10% of the remittances market, let's just assume it's a future date. So remittances market, global remittances market is 500 billion. If we take 10% of that, that's 50 billion in stored value that Bitcoin would need to facilitate. Now, we need to use velocity to basically figure out the amount that the token actually needs to store. So if we assume a velocity of 5, which is the turnover of money or the turnover of the asset, we divide that 50 billion by 5 to get 10 billion in stored value that Bitcoin would need to have in any given year in order to facilitate 10% of the remittance market. So, you know, we would take that 10 billion and you divide it by the number of coins outstanding, which right now we're at roughly 16 million, and you would get an idea, right, of the amount of value stored in Bitcoin specifically for the remittance use case. Now, it gets more complicated for what I would call crypto commodities. So I think of Bitcoin as a cryptocurrency, serving means of exchange, store of value, unit of account, but things like Ethereum, Saya, Storj, Filecoin, Golem, these are more crypto commodities in the sense that I find it puzzling that we have physical commodities markets to value wheat, oil, natural gas, so on and so forth, yet we live increasingly in a digital world, but we can't trade cloud storage futures or bandwidth futures or different digital commodities which are just as fundamental to our lives as wheat and bananas. And so I think that the crypto community is sort of naturally giving birth to these markets, and it makes sense that they trade 24/7 globally and are decentralized in their nature. So are we going to get the presentation?
It will be ready in about 3 minutes.
Okay.
Keep talking for 3 minutes.
So there's a few things that I can prime with. So Saya wrote a good blog post, I think it was David and Zach, a few weeks back about, you know, how to dampen the enthusiasm of the bubble, or not dampen, but just to get a dose of reality. And the thinking was, you know, when we look at CoinCap or CoinMarketCap, what's shown is the current network value. So I use network value instead of market capitalization because market capitalization implies equity. This is not equity. This is a new asset class. So those sites show the network value of the current number of tokens outstanding multiplied by the price. But the problem is, as we all know, for many of the tokens, either there's a much greater amount outstanding that's not yet in the float, and we don't necessarily have an idea about how that will be issued. I think we're starting to see good practices in terms of issuance on an annual basis so that we don't have supply shocks on the market, which would actually hurt the network. But so that's one side. But then for your organically mined coins, we actually have a pretty good idea of the annual rate of supply inflation. And so I'll show something on Zcash. Basically, the market right now, while we may look at Zcash and the current market cap is a few $100 million, the implied current network value, the implied network value in 2025 is north of 40 billion. So we have to start to think about what we are assuming our future looks like. I think we're all bullish, ARK is bullish, but we have to make sure that we know what the future looks like before we necessarily put money to work now, because again, you're going to, as an investor, make money off of future appreciation, not necessarily the current price, right? So that's one thing. In terms of how I'm deriving utility value versus what I would call discounted expected utility value, it's best to think of this as a stacked bar, 100% stacked bar, where a certain percentage of that is the current utility value. And so I gave an example for Bitcoin, and I'll run through one for what I call just cloud storage coin. I didn't want to go with specifics on any token for that one. So a certain percentage of that is your current utility value. If the market crashes, then we would expect that to basically be the price floor. And then on top of that current utility value, there's another percentage, which I call discounted expected utility value. And that is basically saying in 2025, given the adoption of this token in certain markets, using a rationale similar to Bitcoin and remittances, can be applied to cloud storage, it can be applied to GPUs, it can be applied to compute cycles, it can be applied to different things. What is going to be the utility value of that token in 2025? And then I have to pull that value back to present. And so when I stack those two, I get 100% of the market value, a certain percentage of which is current utility, and a certain percentage of which is expected utility. Now, you could call expected utility speculative value, but I think that's not giving credit to the system.
Your slides are ready now.
They're ready.
All right.
So just crypto asset valuation methodologies. So here is Zcash. So I did these slides about 10 days ago, so they're horribly outdated. So at that time, Zcash was a third its current price. But basically, we can thank JP Morgan for that, I guess. So the inputs in this is a pretty simple model. Your inputs are your average annual inflation out to the year that you plan to make an investment. So since Zcash will be issued similarly to Bitcoin, we know in 2025 roughly how many tokens there should be outstanding. And so I can get an average annual rate of inflation. So that's the rate at which the token supply will be inflating each year. And the token has to actually appreciate in value more than that rate of inflation in order for you to make money. So then I use a discount rate for risk. So for example, in high growth tech stocks, this discount rate is anywhere between 10 to 15%. That's based off of its weighted average cost of capital. We don't really have that in the crypto asset space. So this is really just a function of risk. I say Zcash is 3 or 4 times more risky than a high growth tech stock. And so I have my combined discount rate, and I take that discount rate and I have to compound that growth year over year out to 2025 from the current network value. And that basically says, okay, implied network value 2025 is 14.5 billion. Now, given the way the market has changed, if you wanted this same return characteristic, the implied network value in 2025 is north of 40 billion. So we're assuming in 2025, Zcash will be worth more than Bitcoin is right now. But we don't know how much Bitcoin will be worth at that point. This is what I was talking about in terms of utility value. I didn't put up the models in the background, but if you guys want to see the models, I'm happy to take calls in the days, weeks, months going forward and work with you all on this stuff. But basically, I gave a very simple example of how you could do this with Bitcoin. And for example, this is a cloud storage token. And you can do things like you look at the total gigabytes stored in global storage markets, and you assume what percentage is Saya or Storage or Filecoin going to take of that? So then you know the number of gigabytes stored. You have, at least with storage, a fixed price per gigabyte, right? And then so you get an idea of the amount of value the token needs to store in a year. You take that amount of value the token needs to be storing in a year, divide it by the number of tokens outstanding. You get an idea for the storage capacity, but then these networks have embedded CDNs, content delivery networks. So you layer all of this, and you can figure out what your utility value will be each year. So current utility value, again, this is just a random example, would be 7 cents. But in 2025, the expected utility value would be $10.51. So what I do in order to justify the current market price of the token is I take the expected utility value in 2025. I have, again, an expected rate of return. The reason that's in blue is I can fiddle with that input, right? And that discounts the future utility value back to the present. And so the current market value of that coin, trading on, Poloniex, Kraken, GDAX, would be $1.84. Now what that means is current utility value only provides 4% of the value of the token. So if we were to go into a strong bear market, we could potentially correct to that point before there's a price floor. And 96% would be discounted expected utility value, basically a claim on the future utility of the asset. 2013, we corrected 80% after Bitcoin and other crypto assets hit their highs. Went from roughly 16 billion to under 4 billion. So this is where I'm not saying this is necessarily going to happen, but I think it's important that we be realistic about what the value of these tokens is supported by, and the utility value will grow over time, right? Speculation lays the foundation for future innovation. So this isn't necessarily a bad thing. It's just digging into the numbers a bit more. This is another valuation technique. Willy Woo, Dangerous Mouse from Twitter first came up with it. Credit is his. But I really like this. So you take the network value divided by the daily transaction volume, and you get a ratio. And it's similar to a PE ratio for stocks, where a PE ratio for stocks takes the market cap of a company divided by its earnings, the earnings in the stock market being the utility of that company, which is kind of messed up, but I won't get into that. For crypto assets, the utility is the transaction volume on-chain. That transaction volume can be facilitating the actual storage of files, or GPUs, or moving value, or an attention economy, whatever it may be. So I think this is broadly applicable, and I would love to have a website, maybe Smith & Crown, that has a running ledger daily plotted of this. Because what we see here, on the far left, that was when Mt. Gox first came online, right? And so we had rampant appreciation in network value, not accompanied by an increase in transaction volume. And then the other bump that we see is after 2013 into 2014, we saw the same thing. And now, when I look at this, this doesn't look like the market is necessarily overpaying for the utility value of Bitcoin. So that's another potential. And the last one that I'll finish up with is, these networks are fueled by the developers. The developers and then the broader community as well. But in terms of actually building the code, many of you are contributing directly to these protocols. And so how is each unit of contribution being valued? And so I'm writing a book on this space. And so I had to submit the manuscript at the end of March, which is when I first pulled these numbers. And I was like, okay, I feel like I'm starting to see some kind of a baseline. Bitcoin and Ethereum were valued roughly similarly. I pulled the numbers again recently, and clearly everything has appreciated enormously. And yes, this being 10 days ago, it's again horribly outdated. But this is where Ripple starts to potentially look like an outlier. Now, Ripple isn't fully open source. At least I'm still trying to wrap my head around it. So maybe that's what's going on here. Not all activity is showing up on GitHub. But again, I think this is a way to look at dollars paid per code repo point. But then we have to think about, well, what are the meaningful code repo points? This is from Crypto Compares data. It's like stars, forks, merges. So that takes more work. But so in short, these are just a few of the ways I'm thinking about it. it's a bit of a fool's errand. I'm not going to get anything right, but I just want to give all of us a basis of foundation so that we can use this to both help grow the utility of the network, educate new people coming into the space, and if we settle on a few valuation metrics, then it becomes a standard going forward. And it will be much easier to say, okay, this is definitely getting overheated, as opposed to everyone saying, oh, it's definitely a bubble, oh, it's not a bubble. If we have numbers, it becomes much more concrete to say that. So you can reach me at my Twitter handle. I would love to work with any developers that want to value their token or trying to figure out how they should issue their token. It can get really tricky in terms of your inflation rate and how you manage your supply, and you definitely don't want to have a token that's trending towards zero value. So please reach out to me, and I will sit down for the chat.
Let's have a couple of questions because the time. Thank you. So how many analysts are there like you? And I'm wondering, why isn't Morgan Stanley and Goldman Sachs and those companies doing this kind of analysis?
Well, we disintermediate them, so I think that's why. I think in terms of the analysts, it was Spencer Bogart and Gil Luria, right, on the sell side. And Spencer's now at Blockchain Capital, and I know he's continuing to do some work. Gil moved somewhere else as director of research. I guess I'm the only technically buy-side analyst looking at this space from this lens.
But a year from now, I mean, I would assume that there will be more attention on these tokens, and we can expect to see more analysis probably, right?
Yeah, and I think it's going to come organically from the community. Like we look at what Smith & Crown is doing or Coin Fund. I'm working with two professors, Steve and Alessio, who you should talk with as well, who are trying to figure out the utility value. I don't necessarily think that it comes from traditional finance. We've been shocked at ARK that we made this investment 2 years ago and people still don't seem to get it. And so I think we will sort of organically grow this, and then traditional financial services will follow.
Okay, so when you talk about network value, does it make a difference in your model whether we are talking about an application versus a protocol? Do you make a distinction or not?
So I don't make a distinction in terms of how I'm valuing the asset. Now, I guess it wouldn't be right to say that a services layer on top of Ethereum has a network value. I mean, it does have a network value. They all have network values. I'll take that back. But in terms of actually pricing the asset, a lot of this is, what is the size of your market? What percentage are you taking of that? What are you charging per your service? It's going to be interesting to see with things like Saya, where it's dynamically determined. That starts to make it a little harder to figure out the value. But I think we can boil down to something that's pretty universal, that's generic enough to be universal to value crypto assets.
We can take one question if it's short answer, and then we have to move to the next panel. Okay.
How do you, so one of the things that we've struggled with investing in the category is the custodianship issue on a registered advisor. How do you go through that?
Can you repeat the question?
The question is custodianship. How do you secure your crypto assets? And also, if you're coming from the registered investment advisor angle, there's a rule called self-custody, which is actually, we in the crypto space, we want to have self-custody, right? It's autonomy. It allows us to directly own our assets. But per SEC regulation, there was some bad behavior, and so self-custody is actually not allowed. So someone else has to custody your assets. Maybe it's just part of the ruse. But I think that for this, it's working with teams that know what they're doing. So like I know Demian Brenner from Smart Contract Solutions is looking at this. Coinbase clearly has a great reputation in custody if you want to store Bitcoin, Ether-like coin, Zappo. So it's really going to be having to work with some firms that have the right processes and procedures.
Speaking of Coinbase, they are the next panel. Thanks very much,
That's
Chris.
the lead.